Oh, whoa, I somehow just moved all my squares around. That was weird. So
Mhm.
Okay, so we are live, and I believe we have 5. So it's at the pleasure of the co-chairs whenever we want to get started.
Okay,
Thank you, everyone.
How many we need to have a quorum, Susan?
4.
4, okay.
Yeah.
All right, yeah, okay.
Thanks, everyone, and welcome to the investment meeting for September 15th. Sue, can you do a roll call vote for attendance, please?
Angela Banks, Christina Bennett,
Present.
Lewis Cross, Sheila Goodwin, Donna Jones,
Here.
Yvette Levy, she had something come up, Martell Mann, Bobby Richardson,
Here,
Albert Sanders,
Here.
any questions about that?
Doris Walker,
Here.
Justin Stein. Okay, so we do have 5, so we do have enough for a quorum.
Thanks, everyone. Today on the agenda, we have a couple of items, and I'm going to turn it over to Gwelda so we can get this meeting started.
Okay, well, today we have joined with us is Brandon Bond from TCW. He's representing, that's one of the large cap growth managers you have in the portfolio. His colleague came down with COVID. Brian was going to present, but he came down with COVID. So Mr. Bond is stepping in for his colleague. And we'll turn the floor over to you, Brian.
Thank you.
Brandon, I'm sorry.
Oh, no problem. Thank you, everybody, for your time today. I imagine it's been a long day already for many of you, finishing up a school day, but I appreciate you taking the time, and happy to have the opportunity to be here. I wish it was under better circumstances. As Gwelda mentioned, my partner Brian came down with COVID, and pretty bad case, so he's in bed. And so for better or for worse, you have me today. So what I thought I'd talk about with some direction from Gwelda and Jeff is, 1, give you an update on our minority brokerage mandate efforts, 2, give you an update on the firm, 3, give you an update on the portfolio, and then 4, talk a little bit about what's going on in the equity markets in general. If at any point I'm not covering what you'd like to, or you'd like to go deeper in an area, just pipe in or raise your hand and let me know. I'm happy to take this whatever direction would be helpful. So why don't I start with a topic that I know you care a lot about, and that we have a positive update finally, and that's our updates, our mandate to improve the commissions to minority, women, and disabled-owned brokerage firms. As you probably know, commissions were fairly negligible during the first part of the year, and at the end of June, our trading group and client services team worked with you, and as well as our outside trading analytics provider, AbleNoser, to evaluate and implement a new trading process so that we could have better inclusion of minority, women, and disabled-owned brokerage firms. And we've been trading exclusively with those firms since the end of June. So all of July and all of August commissions went directly to those firms. Because the turnover of the portfolio is low, meaning we don't trade a lot, 100% of commissions in July and August only translates to 17.1% of year-to-date commissions. But as we continue this new trading process, we should be able to hit at least 33.3% for the year by the end of the year, and we will be in much better shape to achieve that mandate going forward. a quick update on the firm. There's actually been a lot going on, the most notable of which you may have seen in the press is the announcement of a new CEO at TCW. Katie Koch has been named to replace as a replacement of David Lippman, who our current CEO is retiring at the end of the year. Some of you may know Katie as she joins us after 20 years at Goldman Sachs Asset Management, where she was most recently CIO for public equities and a member of the executive committee in the asset management division. Selfishly speaking, as a member of the equity group, I'm really excited about this. It's really heartening. And her background in equities signals, I believe, TCW's continued commitment to the equity business. So anyway, we're really excited about that move. Still in negotiations as to when she will start, but we're really excited to have Katie on board. As far as our team goes, there's been really no change to the team, as has been the case for many years. Susan, if you could fast forward to slide number 3. The team really hasn't changed in years. The last change was Rob Park joining us in I believe it was 2014. But of course, it's not just the 4 of us managing the portfolio. We are supported by a number of groups, including our equity research team. On the equity research team, we did have one departure. Our financial services analyst left, and we're in the middle of a search for a new financial services analyst. And we've already met with a number of promising candidates, and so we'll keep you updated as that search continues. On another front, TCW has made a concerted effort as a firm to improve the incorporation and integration of ESG factors into investment portfolios across the firm, whether or not specifically having ESG mandates. So as part of that, we've been building a shared research team that we share across asset classes, across teams and funds that are ESG specialists and ESG specialists by sector. That team's up to about 7 individuals right now. And in addition to providing us research and a number of resources, these individuals have begun joining our meetings with companies and helping in that engagement process. We have now incorporated in all of our engagement activities a look deeper into some of the environmental, social, and governance activities of the businesses we own. It makes sense, even though we are not an ESG dedicated fund, we look for sustainable businesses that are going to be around and successful for the long term. And we believe the integration of a look at the environmental and social and governance of these businesses plays a key role in understanding how sustainable they'll be over time. So that's about it for the firm update. Any questions? Did I ever hear a question?
So Brandon, just for the good of the group, and let's talk about the CEO change, because that can sort of vary from firm to firm. So smaller firms, you might have a CEO that's more involved or is on a portfolio management team, and larger firms maybe not so much, but might have impact on how teams are structured, created, so on and so forth. So can you just let the group know what your expectation might be for this team? Does a new CEO mean, well, she's going to come in and start changing up teams and things might be different and the strategy is going to change, and what really could be expected from a CEO change to impact this portfolio, if any?
Sure. Great question. So my expectation with Katie is, first of all, the way the role of the CEO serves at TCW, they have very little involvement with the portfolios and the portfolio teams and investments. And so I would expect nothing to change in terms of our process, philosophy, or team. Her mandate is going to be to come in, and early indications are that, given her equity background, she wants to grow the equities business. And so we are kind of the anchor team in the equities business. So I'm sure we'll get all the support we need, but I imagine there will be an effort to grow other equity portfolios to leverage. We have a central research team that's under levered today, quite honestly. So I imagine there will be opportunity to bolt on other equity teams to further leverage that equity research team. I think if you look at Katie's background too, she's been rather innovative at Goldman Sachs in leveraging existing capabilities and upgrading structures and vehicles. So you could very well see things like, and I don't know that this will be the case, but you could see additional vehicles be added on to our equity portfolio, whether they be an active ETF type of vehicle, more work around CITs. We have one today, but the scale's not particularly large, UCITS, et cetera. And then I imagine there'll be a greater effort to look at distribution and potentially a higher level structuring of products above my pay grade, quite frankly. So I'm excited about what she can do for as a firm. I don't particularly expect anything that would change our day-to-day all that much, nor our investment strategy, nor our portfolio, though.
Great, thank you.
Sure. So why don't I turn to the portfolio then? And let me just start to make sure everybody's on the same page here. Just do a real quick review of what we're trying to do, our process and philosophy, and then jump into performance and jump into the equity markets more broadly. So Susan, if you could turn to slide 6. The most important thing to take away is that our strategy and philosophy have not changed. And as a reminder of what we're trying to do, quality on this slide to us is an advantage business model. So we're looking for companies that have a secret sauce, if you will. Growth, the growth triangle represents large and growing opportunities. So if you have a great business and in a great market or with a large market opportunity, we think that's the formula for a great business. Great businesses aren't always great stocks. So we have the valuation triangle here. And this valuation triangle you should really think of it as we are making sure that we are not overpaying for what that business could look like in terms of cash generation over multiple years under multiple scenarios. Susan, if you could turn to slide 7. The main thing I just want to call out here is that we remain a low turnover and concentrated portfolio. So we invest in businesses for the long term. We concentrate our positions so that those investments, each one matters. On slide 8, this is a slide that represents a number of secular trends or long-term trends that we're exposed to. We like to be exposed to secular or long-term trends. And these are just a few examples of them. When you find an attractive secular trend and you find a great business in that industry or in that marketplace, you tend to be able to ride those and benefit from those over multiple periods of time. So these are just a few examples of the secular trends that we're big believers in and the companies in the portfolio that have exposure to those trends. Slide number 9, the last thing I want to note with our strategy is, although we are a growth strategy, we have not been that optimistic about the economy for well over a decade now, and we think there's still many issues that are yet to play out over the coming years. So we have incorporated what we call a defensive ballast in the portfolio, and that's basically targeting 1/3 of the portfolio. We've targeted 1/3 of the portfolio to be in names that have less correlation to GDP, less correlation to basic economic growth. And so they might have different end market drivers, whether it be things in healthcare or things like American Tower, where they have 5 to 7 year contracts, where you can depend on these businesses when the economy weakens. And so that's been an important part of our portfolio as well. If we jump to slide 17, at the bottom there, you can see performance. And if you look at the bottom line, you'll see the year-to-date numbers and our underperformance this year. This has been an unusual year and quite frankly, a disappointing one. Why so disappointing? It's not just because the markets are down. It's not just because our portfolio is underperforming, but hold that place on slide 17 and let's jump forward to slide 22. What's particularly unusual is, and let me orient you on this slide briefly. So the x-axis is the Russell 1000, which is our index, Russell 1000 growth returns on a 3-year rolling basis. And the y-axis is our portfolio's returns on a rolling 3-year basis. So what that means is any dots that show up in the blue area are periods in which on a 3-year basis we have outperformed the index, and any dots that show up in the gray area are rolling 3-year periods in which we've underperformed the index. What you'll notice is that usually when we underperform, it's in up markets. It's when the market's up. That's why you see most of those dots in the gray area. And it's very rare for us to underperform in down markets. And most of the time, and part of that is a function of the defensive ballast in the portfolio. So again, that's what makes this period a little unusual. We're underperforming in a down market, and that has not been a common occurrence in the past. So let me talk to that. What's gone wrong lately? Sorry, did somebody have a question? So let me talk about what's gone wrong lately, not just year to date, but this all really started last fall as the market started to roll over. The first common question we get is, okay, you have this defensive ballast you've told us about. Did that not hold up? Did that not work? Actually, it did. It did its job. The defensive portion of our fund has outperformed both our fund as a whole as well as the index, and it's been a positive contributor to our attribution. Would we have liked it to have performed better? Absolutely. And was the defensive portion of our portfolio, did it still decline in absolute terms? Yes, it did, but it did provide some ballast to the portfolio. Next question we get asked is, okay, were you too bullish? And were you positioned incorrectly and positioned for the bull market to continue? We dig into this issue a little bit more in our quarterly letter, a copy of which is included at the end of this presentation. That might be interesting for you to read, but that we don't think was the issue either. If you go back and read our outlook section of our quarterly letters, going back to last summer, we were noting increased caution, and we were talking about an expectation for pickup in volatility and potential drawdowns. We were calling out that the market was near all-time highs and that valuations were getting less attractive. So what were we doing about that last year? Well, because we weren't finding valuations particularly attractive, we slowed down the intake of new names into the portfolio. In the second half of last year, we only added one name to the portfolio. That was Nike, and Nike, we got the opportunity because of some issues that had been going on in China that weren't related to the broader economy. But we didn't find attractive investments to add to the portfolio during that period because things were expensive. We had moved the portfolio to an underweight technology position, an underweight consumer discretionary, and an overweight healthcare. Exactly the kind of sector positioning you would expect if you are thinking that you have weaker days ahead. Even within those sectors, we were focusing more on profitable companies. You heard a lot last year about how many stocks or how many high-flying growth companies didn't have any earnings and were trading at very high multiples of their sales, even though they didn't have earnings. We were moving away from that trend. If you look back to last summer and early fall, companies that were not expected to be profitable this year represented only a low single-digit percentage of the portfolio. And if you fast forward to next year, we don't have a single company that we expect will not be profitable in 2023. And we even were trimming back, not only were we not adding new names to the portfolio, but we were trimming back some positions in names that we thought were some of our more expensive names, and again, concentrating those funds into names that were more profitable, we thought could hold up better in a downturn. Yet, despite all this, despite essentially being right at the 30,000 foot view, with market outlook and positioning that seems aligned with that market outlook, we've underperformed so far in this bear market. So I'm going to get into that a little bit more. And before we talk a little bit more about that, let me talk about what we're doing about this, because we're certainly not sitting here crossing our fingers and hoping for better days. The takeaway summary is that we have seen this movie before, if you will. Most recently, we saw it in 2016 and 2018, where we had sharp drawdowns of growth stocks and pronounced periods of acute underperformance. And we're running the same playbook today that we did during those periods. And if you look at how the fund performed coming out of those periods, it tended to have it's tended to have very good years after we have these acute periods as we run the same playbook. So what is that playbook? First of all, we go through the portfolio name by name, and we categorize each name in the portfolio, with the major categories being what we call broken springs and coiled springs. What I mean by that is a coiled spring is a name where the valuation, the value of the stock has come way down, but we don't think the intrinsic value of the stock has come down that much. And so as the earnings power continues to compound for that company, eventually the market will recognize that and will be rewarded. We'll be able to make up that lost ground and beyond. A broken spring, however, is the stock price has come down in part because there is something broken about the business, or there's something about the business that's been impaired, and the stock's not just coming down because of multiple compression, but the stock is coming down because everyone's expectations about what this company can earn in the future have changed dramatically. So we go through the portfolio. When we find these broken springs, we've been exiting, and we've fully exited some when we're in the process of exiting other names. And we've added to and are looking to add brand new names that we believe are coiled springs. And so we want to load the portfolio. We don't know when the bottom will be. Quite frankly, I don't think the absolute bottom, we're there yet. I think we have more pain to go. I think the relative bottom could be close, but we want to essentially stack the probabilities in our favor by loading the portfolio with these coiled springs and getting rid of the dead weight of the broken springs. And we believe, just as it has been the case in the past, that will allow for future periods of outperformance. So let me break down the portfolio returns a little bit for you. As you may have heard, the majority of the declines in the US equity markets this year have not yet been a function of earning estimates coming down. It's been more a result of multiple compression. So a company that I expected to earn $1 next year and used to trade at 20 times that dollar, or $20, now trades at 14 or 15 times that dollar, even though that expectation for the dollar hasn't necessarily changed. If you look at our portfolio specifically, the average multiple or price paid for each dollar of revenue is down 27% since the beginning of the year, and about 35% from a year ago. Given our portfolio, and these numbers are as of yesterday's close, given our portfolio is down about 30% year to date, if you think about the 27% decline in the price paid for each dollar of revenue, you can see that the problem's far less about fundamental problems at our companies and far more about what the stock market is willing to pay for those. When we look at what we expect our portfolio companies to do going forward, we expect them, if you take an average across the portfolio, to grow north of 20%, grow earnings north of 20% next year, and in the high teens to low 20s over the next 3 to 5 years. So when you think about that kind of compounding of earnings growth, where the stock has gotten that much cheaper, the stocks are, call it 30% cheaper, and we're going to continue to grow at a 20% rate over a few years, the stocks either get incredibly cheap within the next 2 to 3 years, or you should have a catch up and be rewarded for that and come to a number that better matches the normalized earnings rate, growth rate over time. You may remember a coiled spring slide we used when we were in a similar position in 2016. If you don't, I'm happy to redistribute that. But we used that, and it was showing essentially a similar thing, what was happening to stock prices versus what was happening to earnings. And as that gap continued to widen, where stock prices were going down but earnings were going up, you were essentially coiling the spring, and then that was able to reverse over time, and you got stock performance in excess of earnings growth in certain periods. So that's what we are predicting eventually, and that's what we're preparing for. Now, let me take a step back and talk about the equity markets more broadly, because it's quite frankly, it's a challenging time across asset classes, as I'm sure you're aware, but it's been a challenging time for the equity markets in particular. And I'm not sure how many other equity managers you have, but we are certainly not alone in this, and you might have heard some of these sentiments before. The challenges are most pronounced, though, in the growth stock area. For example, based on some data from Bank of America, only 22% of growth managers as of the end of August were outperforming the index year to date. That compares with 54% of value managers. So growth managers have been having a tougher time. And the value index is doing 13 percentage points better than the growth index. So why is that? Let me point to a few things. One is the index sector composition. So if you look at what have been the best performing sectors or industries this year, it's been energy #1 by far, utilities #2, and consumer staples #3. And these sectors are all much bigger sectors in the value index than they are in the growth index. So the growth managers don't get a lot of help from those sectors, the value managers do. The worst performing sectors year to date have been communication services, consumer discretionary, and technology. And these sectors make up nearly 2/3 of the growth index. So that helps a bit to account for why the growth index has underperformed the value index. But that doesn't necessarily explain why individual managers are outperforming or underperforming their index. Let me talk another reason that does affect the growth index as well, and that's higher interest rates. You can't go a day without reading about interest rate impact on our economy and what the Federal Reserve is doing. Higher interest rates tend to hurt the valuation of many growth stocks more than value stocks. Why is that? Because more of the value in growth stocks tends to be back-end weighted. And so as you have a higher growth rate, we expect bigger earnings 5 years out and 10 years out. And when you use higher interest rates to discount that value, it tends to lead to a bigger discount. One particular challenge, now I'll get to why are managers then underperforming the growth index at such a higher rate than value managers. One of the big issues has become the top heaviness of the index. What do I mean by that? So the top 2 names in our index, Apple and Microsoft, now represent 23% of that index. The top 5 names represent nearly 39%, and the top 10 names represent 47%. Remember this, they call it the Growth 1000 index, but it's closer to 500 stocks, but 10 of those names make up nearly half the index. So a very small group of names, it has a very outsized impact on the performance of the index. Let me just give you an example. Let's take the biggest name, Apple, for example. Apple has outperformed the growth index as a whole by 11 percentage points this year. And it's sitting at about 12.7% of the index. That means if you owned any less than 12.7% of Apple in your portfolio, it's hurt your relative returns this year. And it's actually quite hard to own 12.7% of any one stock for good risk reasons. So many portfolio managers by compliance rule aren't allowed to have positions that big. Even us, a concentrated manager, we don't like to have positions north of 7%. And our biggest position today is only at 6.8%. So most funds can't or aren't comfortable owning positions that big, even if they are very bullish on Apple. So that tends to create problems for managers across the board. If you look at us in particular, we don't own any Apple. And so not owning that single name has cost us well more than a full percentage point in relative performance this year. So at this point, I often get asked, so, okay, that index concentration issue has made it hard in this environment. Why not just move to an index fund then? And why not just move to passive? The answer is something similar, and that's because the index is so concentrated now. Investing in the index fund is actually a bigger active bet than it ever has been. You're making a very big active bet on a handful of names, and quite frankly, it's a bet we wouldn't take. Let's take Apple for example. I keep coming back to Apple as the biggest example, but there's a number of other examples. Why don't we own any Apple? First and foremost, it doesn't meet our criteria. It doesn't meet our growth hurdles. Apple's average revenue growth over the last 7 years has been in the high single digits, and there's been even a couple negative years. So it's no longer a high growth name. Earnings have been a bit better, but that in large part has been influenced by the massive share buybacks that Apple has been doing. If you look forward, the story is less encouraging in our minds. Their expected revenue and earnings growth is expected to be closer to the mid-single digits. But despite that picture that looks like a less growthy stock, why has the stock done so well over the last number of years? Well, if you go back to early 2016 to today, the multiple, meaning the price the market's been willing to pay per dollar of earnings for Apple, has more than tripled. If you go back to the discussion I had earlier, talking about the price the market's been willing to pay for our names being down 27% year to date and 35% from a year ago, for Apple, that number is down 7%, meaning the market hasn't really recalculated what it's willing to pay for that same dollar of Apple performance. So looking forward, we think it's actually hard to make the case that Apple is a coiled spring like we're trying to fill our portfolio with. The multiple hasn't compressed, and you're talking about a single-digit growth profile going forward. So you can expect if the multiple can stay where it is, which we would not be comfortable making that bet, you're talking about single-digit performance at a flat multiple. And if the multiple were to compress, then you'd have even less than that. Compare that to a name that's growing earnings 20% a year, and you're getting a 30% discount to that today. Further, you probably heard the old adage that it's usually the old guard and the old leadership in the market that tends to be the last to crack. What that means is leaders in the last market cycle are ones that investors have built the most confidence in, and means those are often the last ones to be sold. And you only sell those prior leader companies when you've run out of other things to sell, or when you reach ultimate pessimism about the market. So we consider Apple in that position as well. It's held in far better than most to this point, but we would expect it to be one of the final names to sell off in this bear market. So I spent a lot of time on Apple. I know I apologize, but I could tell a similar story to a number of names that are high in the index now, that have buoyed the index, made it harder for growth managers to outperform in this particular period, but that we don't think create a sustainable outperformer over time. So how do things look from here? I'll give you a few words on my outlook, and then I'll pause to take any questions you may have. quite frankly, we don't think they look that great in the near term. We think there's still problems to come. We think that the Fed is in a tough place, and they're most likely going to have to send this economy into recession to destroy enough demand to get inflation back under control. So not a great environment. Although markets are forward-looking and will find a bottom well in advance of the economy finding a bottom, we don't think we're there yet. But we have our playbook, and we have cash ready to deploy that we've only been slowly redeploying as we look for those names that will be coiled springs on the other side of this economic and market downturn. With sustainable earnings growth in our portfolio over multiple years, near 20%, and the significant haircut already taken, we actually like the prospects of our fund quite a bit as we stand today over the next 3 to 5 years. Maybe not over the next 6 months, but definitely over the next 3 to 5 years. With names like Apple and some of the other very large benchmark names that have helped the index perform so well over the last number of years, we're actually quite encouraged. We don't think that sort of performance is sustainable. And so the relative prospects of outperformance, we think, are improving in our favor. And then the last comment I'll make is, bear markets can be scary and concerning. And this one in particular is like no other for a variety of reasons. Happy to get into some of those with strong job growth and very poor performance in other parts of the economy. But as a wise mentor once said to me, this is what opportunity often looks like. So why don't I pause there and see if there's anything you'd like me to cover further.
Hi, Brandon. I know as consultants, we're often guilty of going about 100 miles an hour and telling trustees, hey, you should have growth in your portfolio and value and have these things diversified. But and maybe page 10 on your report might be a good launching pad. But can you just spend a couple moments and just tell us, because we have you positioned as a growth manager in the portfolio, can you tell the group what a growth stock is, what a growth manager does, relative to a value manager, sort of on that level? Why, and so what are some of the metrics and things that actually make up, what makes Apple or any of these names that you're talking about a growth stock, and why we want these in the portfolio? Why do we want a growth manager in this portfolio?
That is a great question, Jeff. I'm glad you asked that. So let me step back for a minute. So at the most basic level, I would say equity investing is about trying to buy securities at a discount to their intrinsic value. And there's two major fundamental ways that managers go about that. And that gets classified into value managers and growth managers. Value managers often look, at the end of the day, we're both looking for earnings growth. Value managers often look for that earnings growth in the form of a mean reversion, if you will, an improvement in the margin of the business, how much money they can make per dollar of revenue. And with that improvement, hopefully the market becomes less pessimistic and is willing to pay even more of earnings for that company. So that means you're often investing in really old, I don't want to say old guard, old companies, but things like industrials, a company like General Electric. A value manager will say, hey, General Electric used to be this great growing company. They've hit all kinds of problems. And it looks like their earnings are really low today, lower than they have been before. I think they can improve their businesses back to where they used to be. And so those earnings can get back where they used to be. And so that's the kind of investment I'm going to make. So they get to earnings growth through improving a company and trying to get back to where things used to be. Whereas growth managers we are not betting on mean reversion. We are looking for companies that are growing sales at a more rapid clip than the average company. And value is being created by a company continuing to grow sales year after year after year, which ultimately then, if it's a good company, drives profitability, which means the cash generation is continuing to grow year after year after year. Now, in consequence, one thing to keep in mind between growth and value managers is because of higher growth rates, growth managers tend to pay more for a dollar of earnings that we think will grow more rapidly today than a value manager would, because a value manager, the kind of company they would look for isn't going to be able to continue to compound that earnings growth at the same rate for as many years as a growth manager would expect a growth company to. So, so if you step back, if you think of a lot of the technology companies, Apple, Google, Amazon, all of these companies would be considered growth companies. They grow at very high rates. They cost more per dollar of earnings than a GE, a Honeywell, an ExxonMobil, which would be names that value managers are more likely to look at. The way these indices get defined then is a number of different ways, but one of the key ways is they look at the growth rate and the price being ascribed to that. So in terms of an inverse of price to book, or PE, low PE, low price to book stocks tend to find their way into the value index, and higher PE stocks or higher price to book stocks tend to find their way into the growth index, in part because there's a high correlation between those valuations and growth rates. So if I now look at slide 10, let me walk you through what the slide is showing in terms of what a growth portfolio. So if you start with price to sales, you'll see that the price to sales of our portfolio is 5.16x. That means we are paying roughly 5 times the amount of revenue that a company is producing for the average company in our portfolio. The index, the Russell 1000 Growth Index, is valuing each dollar of revenue at about 3.93x, and the S&P 500 Index, which is a combination of growth and value, is 2.63x price to sales. So what that shows you is, yes, we are paying more per dollar of revenue from our companies. But why is that? If you drop down to the projected 3 to 5 year revenue growth number, you can see that, and these are using consensus estimates, not our estimates. It's actually a little higher on our estimates. Our average company is expected to grow sales 15.6% a year over the next 3 to 5 years. If you look at the S&P 500 Index, those companies are expected to grow sales 8%. So we're nearly double the sales growth over time that the S&P 500 Index is. And we actually have more growth in our portfolio than even what's considered a growth index. And then you could see that translates into faster earnings growth, the 18.89% versus 12.36% for S&P. So why would you want to invest in growth companies if you're buying on average more expensive stocks? Because the opportunity comes from compounding that growth over time. If you have listened to people talk about Amazon, for example, for the last 2 decades, anytime you were to turn on CNBC or the TV or talk to somebody investing, they would probably talk about how expensive the stock is. Well, what they mean by expensive is the price you're paying per dollar of earnings that exists right then or is expected to exist in the next year. What you're not factoring in that calculation is, what are the earnings and the cash flow generation going to look like 5 or 10 years from now? And if there's a sufficient growth rate, then it's going to be worth a whole lot more 5 to 10 years from now, and you actually can't say that it's expensive today. It's actually cheap today in light of where the potential for that company can be 5 to 10 years from now. So as growth managers, we're looking for those disruptive businesses that some people would say are too expensive today, but that if that advantage business model and large market opportunity play out 5 to 10 years from now, they're going to be much higher valued companies, and that the market is good at deciding how much to pay. The market is efficient, if you will, at deciding how much to pay today, but it's very inefficient in understanding what things could look like 5 to 10 years from now if things go right. Long-winded answer, but does that help?
I think that's helpful, and I'll open it up to the trustees as well, because I think we just want to give a better context to everybody again of what the world of people that pick stocks are doing and why they do what they do. And again, I know we always throw around a lot of terms like growth and value and earnings and things like that. So sometimes I think it's just important to step back and just say what does this mean and why do we want it in the portfolio? So, and I guess the other I'll just throw one more question on top of that, because you did talk about, I think you did a good job of explaining that we're looking at things that tend to have a better projected growth rate. And then you've talked about valuation, which is how expensive is a stock for that expected growth. So I'll just talk about, again, we see a lot of numbers on your page here too, but you have what is the PEG ratio. So maybe you can explain to everybody what that is, because I'll look at that and say, from what you just told us, we always want to pay less, or we want to have the lowest multiple possible for whatever our, number one, what our earnings are, but what our growth is expected to be too. So I would look at that and say that gives us a little bit more apples to apples relative to your index and also to the S&P, which has those value stocks in it as well, and say, well, is it, at 1.77 times, we're still paying more for the growth than we are paying for the growth if we were just in the index. So why would we do that?
Yeah, that's a great question. So just to level set on what this PEG ratio is you take the price to earnings for a company. So if they're earning $1 and the stock is trading at $10, that would be a 10 over 1 or 10 PE, if you will. One way to normalize that PE, because companies with different growth rates will trade at different valuations, you're obviously going to pay a higher PE for a company that's growing faster than a company that's growing slower. We often use what's called a PEG ratio, and it's where you just divide that PE by the growth rate. And in this case, looking 1 year ahead. And so that helps to normalize it a little bit, but it has one major problem, and I'll get to that in a second. Let me call out that what's important to note is, yes, we are paying what this PEG ratio of 1.77x says is we are paying more per percentage of growth than you pay with our index or the S&P 500. It's a little misleading because we have two stocks in the portfolio that are have just barely become profitable. And so as you probably are aware, when you're dealing with small numbers, they can have dramatic impacts on percentages and whatnot, and skew numbers. If you take those two stocks out, you're still left with over 95% of the portfolio. The PEG actually looks very similar, if not a little lower than the Russell 1000 growth index. So one, that's a little misleading, but even if it were 1.77, and that was a true apples to apples number, the thing that people often miss when thinking about growing companies is that the correlation between growth rates and valuation is not linear. And the PEG ratio assumes a linear relationship. That means a company growing 20% versus a company growing 30%, that gap in valuation that you will see is much bigger than the gap in valuation you might see with a company growing 10% to 20%. So there's still a 10 percentage point difference between those two companies, but it's a exponential relationship, not a linear relationship between growth and value. So if you are traditionally investing companies with higher growth rates, you oftentimes will see a higher PEG ratio just by virtue of that relationship. And how does that work out? I won't get into all the math and numbers here, but the compounding impacts of growth rates produce significantly different results over time. So if I have a company compounding at 10% a year versus a company compounding at 9% a year, and I look out 5 to 10 years, that gap gets very wide and it's very meaningful.
Great. And then also just again, from a more, I think, ground floor level, is it just fair to say also, all things being equal, all things being equal, that when, again, we're looking at a lot of numbers on a page here, but anytime we see a ratio that has price involved, the lower the number, always the better. And when there's something without price, like if it's a growth number, the higher number, the better. And then I guess with something like debt too, which is how much we're borrowing, that a lower number is better as well. Are those all fair generalizations?
Yeah, that's very fair. And so I guess one thing I would consider as we look at, again, all these numbers, what these numbers say is, yes, we have a higher growth portfolio than the index. That translates into paying higher ratios per dollar of revenue or earnings, what have you. Generally, when you're growing really fast, you tend to be a company with lower debt, and you tend to not use that cash to help you grow and not pay it out in dividends. So all of that is absolutely true. What is important to keep in mind, though, in investing, and I come back to an initial statement I made about intrinsic value. Ultimately, investing is trying to buy stocks that are trading below their intrinsic value. And so if investing were as easy as looking at just these ratios that can be easily calculated and buying companies with low ratios and selling companies with high ratios, I wouldn't have a job. Computers could do all of this marvelously well. Where the judgment comes in, and the judgment in our view is the difference maker, because as I described before, if I look at a company and I have to make judgments about what's going to happen 5 years from now, there is a wide error band around that. And if I have to value what that could look like in 5 years, there's a wide error band around that as well. But you're not going to capture those scenarios and those possibilities in a simple single metric that you could feed to a computer and they could do this work for you. So the competitive advantage we seek, or what we believe is our most important job, is one, identifying companies that have a secret sauce that will be able to gain market share or grow faster or be more profitable than other companies in their industry, and to have those companies be in a large enough swimming pool, if you will, not stuck in a small pond, but have the ocean to use those advantages for, and then evaluate, if you have a large market opportunity and a great business, how big that can actually become a number of years out. And that takes judgment and practice, and cannot be summed up into a single number that you could feed into a computer and say, oh, I'm buying a cheaper, expensive stock. So when we want to buy cheap stocks too, but our definition of cheap is not what the price is per next year's earnings. Our definition of cheap is, hey, I've got an Amazon in the year 2000 And as I look out to 2010, this company is going to be worth 10 times what it is today. And that's cheap.
And then
Great.
I have one question. The information you have here is through the end of June. Do you know how you all are doing quarter to date? We have the August numbers, but I don't know how the market has been really tough, real crazy these last few days. Do you have any idea where TCW stands quarter to date or calendar year to date?
Sure, I will give you the numbers I have as of today's close. We're down just over 31% year to date for our composite. And on a relative basis, that's underperformance in the mid 6% range, call it 6.5%.
Okay. Any other questions from the committee or Jeff?
I will just jump in with one more, and again, if we can keep it as brief as possible, but I think just to give the trustees a little bit more flavor on why you do what you do with this portfolio. So I just look on your buys and sells, and I just want to think about things names that I know everybody has heard of in this portfolio. So Microsoft was a sell. So in a quick bullet point, why would you sell something like a Microsoft and then, or I'm sorry, buy something like a Microsoft, and then you had to sell Netflix? Why would you sell something like Netflix? So just a couple bullet points in a minute or so here.
Yeah, great questions. I'll start with Netflix. I mean, the simple answer is Netflix would be what I would call a broken spring. Even before the most recent challenges, Netflix, we were getting a little bit more concerned because our thesis around profitability wasn't showing up in the numbers. And so we weren't as confident in those out year numbers, if you will, those sales potential 5 years out. And ultimately, we concluded Netflix is more of a broken spring. Microsoft, on the other hand, we have owned Microsoft and not owned Microsoft over the last number of years. Over the last, call it 5 or 6 years, we have not owned Microsoft because we have found much faster growing and much more attractive software companies. As we come to today, though, Microsoft has really transformed itself and is not just your desktop Windows and Microsoft Office player anymore. It's moved to the cloud and subscription business, which we think is much more attractive. But more importantly, it has become the #2 public cloud service provider next to Amazon. And that is a phenomenal business in terms of growth rates, profitability, and moats around the business, if you will. So as we evaluated going into a downturn, Microsoft became much more attractive because it's already very profitable, has a fantastic balance sheet, has a lot of cash, is not that expensive in our view, as well as on a multiple basis compared to other software companies. And yet the growth rate is accelerating and it's more attractive as a growth name over the last few years.
Great, thanks.
Are there any questions from the committee before we move forward? No? Okay.
I appreciate it. I don't have any questions, Gwilda. Thanks.
Okay. Thank you so much, Brandon.
Thank you, and thank you for your time and what you do.
Thank you, Brandon.
Thank you, Brandon, for stepping in today.
My pleasure.
Okay. Any discussion at this point? It was good to hear that they are coming up in their brokerage numbers. So hopefully we'll see some more forward movement when we get the third quarter report, and certainly after the fourth quarter report. You'll see in your flash report that, and it also shows in our market charts on the page in the flash report that growth has taken a big hit. But all the markets have, but growth more so than value. You'll see that in the charts that we will go over in a couple minutes. Is there any discussion by the committee before we move forward?
Well, I just had a question on what are your recommendations for us to move forward? Because obviously they have a new CEO change, and usually any type of senior management change would also trigger something for us. So we just would like to know what your recommendations are for us.
Well, I think we've already, if I'm not mistaken, did we not put them on
Mhm.
probation already? They're on
Yeah.
probation already. With the CEO not being integral in the actual management of the portfolio, and I believe this is a planned retirement, I think it's going to have less of an impact on the actual portfolio based on our knowledge, what we've gotten thus far. So I think they remain on probation. We have been talking about possibly how to reposition this. He did make a good point today about the index being highly concentrated, because I know we were thinking about possibly indexing this portion of the portfolio. Jeff and I need to talk about that a little bit further. Jeff, any
Right.
thoughts?
I liked that part of the discussion and the index knowledge, because again, like you said, it would put a lot more risk on 50% of the portfolio being in
10
what?
names. Yeah.
10 names, right? Even if you index, you're still, when you think you got a 60-40, you really actually have an 80-20 possibly. So yeah, why don't we revisit that?
Exactly. Any comments, Jeff? Any thoughts?
No, I think, as you said, they're on watch. I mean, if we want, just, I think for the record, just to say this is sort of another item to add to their check marks on the watch list, to say they have had an organizational change. As Gwilda said, I don't think it brings us immediate concern that it's going to change their process or philosophy or the team, but certainly an additional item to monitor as the new CEO comes in, just to make sure that, again, you never know with culture. Sometimes it's,
Right.
This guy seems to say he likes the CEO a lot, but maybe there's someone else on the team that doesn't, and says, hey, this is my reason to go out and resign because I don't like this person. So it's always something we will keep an eye on. And from the standpoint, a manager that's already on probation, just sort of add it to the minutes to say this is another item we're keeping an eye on.
Exactly. Okay. If there's no further discussion, I guess we will bring up the flash report. Susan? Okay, if you'll turn to the next page. I'm not going to spend a whole lot of time. He already gave kind of a brief overview of what's going on in growth versus value. But as you can see here, for the month of August, July was a good month, but August, Jeff, how come I always get the ugly months? So for the month of August, as you can see here, we experienced negative numbers. The only thing here positive is the MSCI emerging markets, so the slight positive 0.42. For year to date, as you can see, we see significantly negative numbers. The Russell 1000 growth having the most negative return, which is a large cap growth, which TCW manages at a negative 23.2 year to date. If you look over to the right, those green, yellow, and I guess orangish color bars there, that shows large, mid, and small on the vertical axis, and then the style, value, basically core and growth. And you see here value, albeit negative for both large, mid, and small stocks. It is less negative than growth, which is the more orange colored bars. So growth has taken a hit. as you all know, or have looked at over the markets over the last several years, our growth led for a very, very long time. But now we've seen a reversion, and that's one reason why we preach style neutrality in portfolios, so that you have an all-weather portfolio. Fortunately, you do have an offset with your large cap value managers, and you will see how that plays into the portfolio total return in that segment. If you look down on the page, you see fixed income here. With interest rates going up, you're seeing fixed income numbers are not good. And the broad US fixed income, a negative 2.83% year to date, brings broad domestic fixed down to a negative 10.75. You see corporate investment grades, which is a large portion of that, not doing well. High yield down, and the global aggregate representing international bonds, even more negative than the domestic bond portfolio. Down at the bottom of the page on this left-hand side, you'll see year to date, the two segments that have the best returns. As he mentioned in his presentation, you'll see here that utilities and energy had some of the segment returns, had the best segment returns, and the least negative was consumer staples. So, things are very defensive. Value managers tend to do better in these types of environments, and that's what you're seeing on a relative basis. If you turn to the next page, this is actually your targets, as we've mentioned before in the past, and the ranges. The lines in the middle of the gray bars represent the targets for each of the asset classes. The gray bars represent the lower range and the higher range, or the full range that you can move around and still be somewhat within your asset allocation, your strategic asset allocation. The only area here you can see is red. Outside of that range is the hedge fund. What I will say here on this page, though, is that we're moving around and restructuring the portfolio and rebalancing the portfolio. So as we finish that up, you should see these inverted triangles move more towards the middle, or the target for each of the asset classes. But we're in the interim stage now where we are liquidating and moving around and rebalancing some of these segments. So these numbers look more in line as the fourth quarter liquidations and rebalancing occur.
The other thing I'll throw in on that with respect to that hedge fund and that triangle that's outside of that range, and as Gwilda said, it's part of the restructuring, but that one's also a little bit more challenging relative to, say, if our large cap equity was out of whack, we could go in and basically on almost a daily basis, or a couple of days, ask a manager to sell a portion of their portfolio, or to do something, or we could move money from somewhere else over to them and get it in line a bit quicker. With the hedge fund managers, they have a couple of mechanisms in their structure that are a little bit tricky, and one of which is that they'll only allow you to pull your money out on a calendar quarterly basis. So that's one constraint that you have, that you can only get the money out each quarter. And then the second constraint is that they also have a notice period. So you can get your money out on September 30, but you also have to tell us 70 days in advance of that time period to get it. So it actually, it makes the timing a little bit tougher. And so where we're at this point is to try to get ahead of it, that we want to get that money out on December 30 and then have plenty of notice period to do that. So we just have to, whenever we're doing these rebalancings, we always need to figure that in, what the timing will be, what these notice periods will be. And so that all had to get factored into this restructuring. So we would expect after the end of the year that we have that portion back in line with respect to policy. But again, as our operating guidelines are written, we monitor on a quarterly basis, and any quarter that we are out of compliance here, that we're making the movements necessary to get us in compliance, and that's what we are doing here. So,
okay. Move forward to the next page. Okay, this is the roll-up of the fund. As you can see here for the month of August, you can see the portfolio is a negative 2.2 versus a negative 2.67, which means that on a relative basis, the total fund did better than the policy index. As you look down the page, you'll see here that domestic equity actually added value a little bit on a relative basis and outperformed the Russell 3000, which represents small, mid, and large cap stocks, both growth and value, at a negative 3.68 versus negative 3.73. As you go down the page, of course, you know the Mellon Stock Index is just the stock index. So that's just copying what that is. One of your better performing managers on a relative basis versus their benchmark is Edgar Lomax, a negative 2.62 versus a negative 2.98. They represent a large cap value manager. So as you can see here, not only are they outperforming on a relative basis, but the numbers are less negative than in the growth index. On a long-term basis, Edgar Lomax has brought up their numbers. At one time, they were having a lot of difficulty, but if you look across the page, Edgar Lomax is now outperforming its prospective index in most periods, with the exception of the 3-year time frame. But since inception, they are ahead of that Russell 1000 value. Intech is your other large cap growth manager. As you can see here on a relative basis, they actually outperform the Russell 1000 growth of negative 4.04. Long-term, they are also challenged versus their the growth index, as is TCW. TCW, though, if you look at the since inception number, is a stronger performer since their inception, albeit they've only been since 2012, whereas Intech has been with you since 2005. Intech is more of a quantitative manager, and they're on probation for their brokerage, and I believe as per for the performance as well. So that's the segment of the portfolio that Jeff and I've got to really do some hard thinking about, because of how growth is performing and the fact that the index that they're compared against is so concentrated. If you move forward to the next page, we've got your small, mid, micro cap managers here. As you can see, Westville had a difficult quarter. Actually, all of your small and mid cap, both growth and value, as well as small and micro cap, all underperformed their respective indices for the month of August. We'll have more color on this once we get to September and get some commentary on what's going on in those portfolios, but they all underperform versus their respective indices. With respect to international, albeit negative, Fidelity did outperform its custom benchmark of negative 4.95 versus negative 6.07. Since inception, the manager has outperformed, had some difficulties within the last 12 months, but if you look at the 3, 5, 10-year and since inception numbers, they are ahead of their custom benchmark. Causeway, more of a value manager. You can see they underperform relative to their index in the month of August, negative 5.58 versus negative 3.37. As far as year-to-date, fiscal year-to-date, and longer time periods, they're either in line or ahead of their custom benchmark. So some short-term underperformance relative to their benchmark, but long-term, we have no concerns there. If you drop down to the emerging markets, this is the one positive area in the as far as the benchmarks and manager. In DFA, which is more of a value manager, as you can see there, they did not perform up to snuff to the index, but it was a positive, eked out a positive return. But what's more telling here, they actually have held up in a negative market environment. If you look at the 1-year number, they're off 11% compared to their index is off almost 22%. Long-term, the numbers are competitive versus their emerging markets market index. Invesco is your other emerging markets manager. They have had more of a tough time. If you look at their numbers relative to the emerging markets index, For the month, they're off 1.7% versus the positive 0.2. Fiscal year to date and the 1 year numbers are not looking good. The 3 year number is competitive, but the 5 year and since inception numbers not so good. It'll be interesting to see how they fall out come the end of the quarter and see if they can bring some of those numbers up. We'll turn to the next page, Sue. Here you've got Exponence, and as you can see here on a relative basis, the Managers program actually has outperformed MSCI World with a return of negative 3.81 versus negative 4.18. Actually, Jeff is going to make some comments regarding the sub-managers in a few minutes. I want to make sure I don't take up all the time. But what's important here is even though this manager has only been with you since 2020, if you look at the since inception number here, they have added value over and above their benchmark, outperforming that benchmark. You can move forward to the next page. In fixed income, this has been a tough time for fixed income, but your two core managers, Manulife and Ernest Partners, on a relative basis, have both exceeded the return of the Bloomberg U.S. Aggregate Index, negative 2.44 for Manulife, negative 2.66 for Ernest, with the benchmark being a negative 2.83. On a long-term basis, since inception, you can see both of these managers have added value over and above that benchmark on a long-term basis. So no concerns really in the core fixed income. Opportunistic fixed income, here, your best performing manager on a relative basis actually has been Loomis Sales, just slightly negative, a negative 0.07 versus their benchmark at a negative 3.82. Their since inception number not as strong, but looks like they're coming back with this particular month. We'll see how they pan out. But they got a deep hole to come out fiscal year to date. They're off 7%. Versus their benchmark only off 0.25. The TIPS index is just a TIPS index. We've got a couple opportunistic managers. Neuberger Berman is a global fixed off 2.69 versus almost negative 4% for their benchmark. Some difficulty in that portfolio long term. Lazard, less negative, significantly less negative. The next relatively best performing manager, their EMD, negative 0.24 versus a negative 2.45. And Exponence, as you know, this is a very different kind of manager. The month they're off this month, but if you look at the long-term number since inception, it's 1.54 versus the Barclays aggregate at 0.96. It's a very different portfolio than what is of the aggregate index. The next page, I believe, okay, the global PIMCO All Asset Fund. You can see here actually protected versus their benchmark, negative 2.03 versus negative 2.73. And since inception, this manager has done well. If you look at fiscal year, 1 year, 3 year, 5 year, 10 year, and since inception, this All Asset Fund has added value over and above its respective benchmarks. Hedge funds, you can see here that Intrust, as we know, that's just I think it's a couple securities. It's off slightly versus the hedge fund composite. White Box actually did well here. You can see for the month 2.98 versus 2.10. This has been a portion of the portfolio that has added value over time. As you can see here, White Box is ahead of its benchmark significantly for all time periods measured. Grosvenor for the month is also ahead, has had some ups and downs, but on a long-term basis, they have done well since inception, 6.14 versus 4.15. And I believe the next page is real estate, and we don't have, of course, updated monthly numbers on the real estate. Let me move over to the next page, and then I want to turn the floor over to Jeff. If you scroll down to the next page, Sue, we can get to the bottom numbers, the roll-ups. Go one more page. Okay, this is the market value as of the end of July, was 828,827,636. You'll see the contributions there. You'll see the distributions, about $8.9 million. We saw market value losses, paper losses of almost $18 million. And that's how your market value ended at 802,781,459 as of the end of August. We're still seeing, I guess I know you all have seen the markets. It has been a really ugly, especially the last several days. So it looks like the September month, unless something turns around, it's going to be another tough month, another tough quarter. But we'll just wait and see. Jeff, do you want to give some color on Exponence, and then I'll make a few comments on a letter that Sue received? Or any questions? Let me ask first. Are there any questions from the committee regarding anything that has been presented thus far?
Gueldo, the only recommendation I have is that you look at the numbers before you decide if you or Jeff are going to present. So you at least get a chance to present positive numbers.
Well, I know, right? No, you know what? I should have told him to do it this time.
So here's what I'm gonna do. Before I jump into Exponence, I'm gonna let Guelda give some other good news that we had. And Guelda, do you want to talk about the melon fee?
Oh, no, you can do that. You did a lot of work.
Well, look at her. She's giving me all the good news.
Go ahead. I'll be the heavy today, but next time you're going to give the ugly numbers next time.
She's really helping me out today. So yeah, if there's, I guess, a point of good news in all of this. So, and since we have all the numbers up, and Sue, if you want to maybe jump back up to the first performance page where we have Mellon, just so everybody can at least see the market value. So if you recall, as part of the restructuring, we gave more to the Mellon index. So that went from, what was it, roughly $5 million up to over $20 million. And as part of that, we were looking at the fee, and the fee that the system was paying to Mellon for this index was 0.08%. So even at that lower level of assets in the fund, a 0.08% fee for an index fund is relatively high. Now, again, if you look at averages, that's still pretty low because there's a lot of other products out there that we would just never recommend, but they fall into the universe that are more expensive. But if you just think of the things that we would recommend as far as index funds and where they should be priced at, the 0.08 is high. So really 0.03, 0.04 is probably in the range of what we would expect to pay, not only at the former level, but certainly when we're at a level of over $20 million. So we took that back to Mellon and said, it's expensive. Yeah, you sharpen the pencil. And so they came back and said, yes, we can bring that down. So they brought it in line with where the Mellon Tips Index fund is. So that's 0.03%. So essentially on the $22 million, that takes your annual fee from around $18,000 down to a little less than $7,000. So again, as part of good news and right sizing, as we continue to look at fees and things relative to averages and getting those in line, that was one that certainly stood out for us. So we did get that one back in line.
Thank you. That's wonderful news.
So that's positive news.
I had a concern. When Guelda comes on in the future, why don't we play some Jaws music in the background?
Oh my goodness!
And then everybody will know what's coming.
Oh,
how about that?
Oh wow! Jeff, you're gonna take this next time. You're gonna take the ugly next time. Okay.
Yeah, we will do that.
I'll spread the love with you. You can have it.
Yeah. Guelda's got to get some glory. We'll give her some glory at some point.
Oh my goodness. Okay.
So, Jeff, do you want to go over Exponence?
Yeah. So, Sue, if you want to
Exponence, there was
pull up the Exponence document.
Okay. All right, hang on.
Maybe while Sue's bringing this up, I'll just preface it. If you recall at the last meeting, I think Christina brought it up that let's take a closer look at the Exponent's global structure. So I'll talk a bit about that today, and we asked Exponents to put together some slides. So what I will tell you, the first few slides that I will talk about, I can give some context about the structure. I know the latter part of the slides, it's a little bit more detail into their due diligence documents on the manager. And again, let's talk about it from a 30,000 foot view of what Exponents is doing on this global equity portfolio. And as Gwilda had mentioned before, when she was looking at the performance numbers, this is a manager of managers. And while we have the individual sub-advisors listed in our report, those particular managers, and Sue, if you want to flip forward one page, so where you see Arga, Foresight, Martin, Redwood, and we have those on our report, but those are sub-advisors. So we've actually, we've delegated to Exponents the authority to go out and select those underlying managers. So you as a committee and as your board don't have direct discretion on those underlying managers. We've delegated that to Exponents. So when you see things at the back end of this report that I won't spend a lot of time on, it's more of Exponents due diligence document, because similar to how we come in and we as a consultant evaluate Exponents for their team, their expertise, their ability to select these money managers, and even on the fixed income portfolio, again, evaluating their portfolio manager, their risk management process, how they select securities. Exponents is doing that for these underlying sub-advisors. So they're saying how effective is Arga's team in Foresight, in Martin? What do their individual portfolios look like? And more importantly, are they selecting a group of, and here it's 4 managers that have portfolios that complement each other? And so not just picking 4 managers that are all investing in the same things. And again, you'll see some examples on a couple of slides that say that they've done a really good job of that. And in particular, as we look at this group of managers, and we can sort of liken this to what you heard from TCW. And I think you'll see a lot of metrics on this page that are somewhat similar to what Brandon at TCW showed us, and talk about valuations, that you have a mix of managers that do things that are more growth oriented. So if you think about Martin and Redwood are more growth managers, so they're going to be looking at those companies that are having more rapidly growing those underlying earnings and sales and things that fall into that category. And then you have 2 like Arga and Foresight that are value. So again, not big on that earnings growth, but have really that cheaper stock price. They're more the companies that they're going to look at are really more staple brick and mortar type companies, not the high flying things, but again, they're good overall favorable valuation. So you really have a mix of those types of strategies. And again, as we go through this as well, I apologize. I'm in a hotel and I have a connection issue here. Hopefully, I'm not cutting out on everybody. But again, and I'm not going to go through a ton of these metrics, but again, I just want to liken things to some of the things that you heard from Brandon. And if you look at just a couple things, so dividend yield. So if you think a dividend, that's actually money that comes into a company that they make extra money, and rather than pumping that money back into the business, they'll pay it out to shareholders as a dividend. So companies that aren't growing as rapidly tend to do that. And so those fall into a value category. And when you see dividend yield, well, what is that? So that's just the percentage of how much is in dollar terms that dividend they're paying out relative to what their stock price is or what the value of their stock is. So the higher that number you see in dividend yield, the more they're paying out in a dividend. So again, value oriented companies and managers, you would expect that number to be bigger. And then the growth oriented managers like Martin and Redwood, those are lower, because rather than paying more money out to their shareholders on a quarterly basis, they're using that and recycling it back into the company for growth and to have higher growth in the company. So just one metric that's kind of important to look at. And again, and I don't think Brandon talked too much about that because their portfolio is not really dividend oriented. Price earnings, now that's that valuation that we talked about. And that's the one that we say, all things being equal, lower is better. We want to pay less for, so again, that's what our price is relative to how much we earn. So the lower that number, the better deal we got. So we paid a lower price for something that actually is doing well for us, is actually making a lot of money. So, and again, the way that generally works between a value and a growth manager is that more value-oriented managers, we expect that that factor, that price earnings ratio, to be lower relative to what we see on a growth manager, where that's higher. So we're paying more for that expected growth, again, as Brandon said. So again, just a couple things, and I don't want to spend a lot of time on this because a lot of these metrics tend to look at those same things in a different fashion, but I think that just gives us a better idea here of that we have a good mix of managers and life cycles from something. And again, I like to also think about this in economic terms, because that's what Exponence has really done. And when there's a chart, and it's not in this book, but they sent it out in a memo not too long ago when they switched managers, when they brought in Redwood to replace Applied Research. And really each one of the managers in this portfolio falls into a different category within the economy. And from ARGA, that tends to be a little bit more early stage after a recession, to Foresight, which is more in the middle of the growth stage, Martin, which is going to be really in the heart of the growth in an economic cycle, and then Redwood tends to be more at the end of an economic cycle. So that's sort of how Exponence looks at these. But again, a lot of those things sort of coincide with these value versus growth principles that we talked about as well. But I think bottom line, they're all very different managers. They do different things. They look at the world differently, and they pick stocks differently based on that. And it gives you a very nice diversified portfolio construct. So again, just from, we talk about not taking a lot of risks. And I apologize, I didn't catch this. Redwood didn't have their number of securities in here, but if you see from the other sub-advisors that they have 60 plus for ARGA, Foresight 44 plus stocks, Martin over 50, and I think Redwood is somewhat in that range as well. But again, when you think about things that are more risky and create a lot of volatility for us on a single manager basis, a portfolio that has less than 20 stocks will be much more volatile. When you start to get to the level of 30, you have a pretty well diversified portfolio. And when you have more than that, it just continues to add to that diversification. Now, again, when you look at this portfolio and add together, you have a couple of hundred stocks, because 4 managers with 50 to 60 stocks each. You have a good amount of diversification in that portfolio and overall risk mitigation. So I'll pause there on these statistics and generalizations on the value versus the growth and where the managers are in the economic cycle, and see if anybody has any questions.
No, I really like the detail because we didn't get this at the inception. So I appreciate it.
Great. Why don't we flip forward to the next page? And again, a lot of things here that you see, but I think what's important to understand here And again, let me just back up and tell you exactly what Exponence and each of these underlying managers is trying to do. So they are global equity managers. And so when we say global equity, that means they can invest anywhere in the world. They can invest in the United States, and they can invest in the developed international markets. They can invest in the emerging markets. And to give you an idea of what that total universe looks like, you look all the way to the right of these two charts. It's the MSCI All Country World Index. And so that's the representation of the total world equity opportunity set. And that's sort of what each of these managers that's the playing field that they're selecting their stocks from. So if you want to think about, that's the benchmark, and then look at what each of their compositions is relative to the benchmark, it gives you an idea of where they might concentrate. But again, what's important here is if you look at each one of these managers and you go down, the ARGA column, the Foresight, you might see some holes. So you'd see ARGA that they're not doing anything in Austria or Belgium, but then you go over to you go to Foresight, well, they do. And then, so anywhere where we sort of see holes in each of these portfolios, other managers might be involved there. So again, that's good, because where one manager might have concentrations that might represent risk for the portfolio, another manager will be filling in the gaps there. So when you add it all together, you'll see that a lot of those boxes on an aggregate basis should be filled in and should start to look a lot more like the index composition. So and if you look at, again, what does the index sort of look like between US and international stocks? Well, if you go to the right and at the bottom, you can see the United States, and the index all the way to the right is at about 60%. So that's the general composition of the total world equity index. 60% of it's US. So that's a very big market from an economic standpoint, from the world standpoint. So it's what we'd expect. That's going to be the biggest portion of the index. The other 40 is everything else. So for the most part, if you look at the other the three of the managers, Foresight, Martin, Redwood, they're all pretty similar to that index composition. So they're going to have the bulk of their portfolios in the US, and then the rest of it to the other extent in the other markets. The one that's the most different is ARGA. So they're very light on the United States. And again, I think if you look at it from, by design and why Exponence has chosen them to be in the portfolio, it is to have that different factor. And there's another thing that I'll throw in about ARGA that's going to make them a bit different from the rest of the group as well. Not only are they more concentrated in things that are outside of the US, but they're also the one that probably has the most emerging markets exposure. So if you look at the other three sub-advisors, not as much emerging markets exposure. So again, ARGA makes a nice offset in that they don't have a similar US versus non-US composition, and then even in their non-US composition, more in those emerging markets. So I think if you think about this, all four of those managers from a risk and reward standpoint, ARGA is going to have the higher level of volatility within the portfolio because non-US stocks tend to be more volatile than US stocks, and emerging market stocks tend to be more volatile than developed market or US stocks as well. So they have more of that, it's more volatile, but again, that gets offset, diversified, and dampened by the other three managers in the portfolio. So we're not taking on a lot of risk. And then again, think about just this. This is a 4-manager subset, but in total for the system, these 4 managers only represent 5% of the total system. So again, just to think about how how well this structure is diversified and positioned and risk controlled within the standpoint of the overall systems portfolio. It's not creating a whole lot of risk, but again, it does something very different from everything else in the system. It's very different from our US equity managers. It's very different from our international managers, and certainly it's very different from our fixed income managers. So, and again, we like that because things that are different and act different in varying environments give us diversification and, in better world economic scenarios. And when we start to come out of recession, things like this start to do better and add more value to the portfolio. But also, again, we'll mitigate risk in different times, and we'll do things when other parts of the portfolio are not doing as well. So we like that construct. I'll pause there on the regional exposures. Okay, why don't we flip forward one more page? And again, something that'll look a little bit similar to what you saw in Brandon's presentation as far as how this is laid out. But these are the different sectors, so where stocks are. And again, this is a fairly standard classification that people look at just to say, we know that different sectors of the economy and in the world act differently, that a technology stock like a Microsoft does different things than a consumer discretionary stock like Coca-Cola. And so we always look at things differently and bucket them differently, and these individual managers do the same thing. And so again, I want to back up to how Exponence looks at the world and how they put managers together. So again, it's to sort of say, let's make sure that we have, we don't have managers that are all doing the same thing. And when we bring them together, we want to have risk characteristics and things that look similar to the overall benchmark or to the overall opportunity set, which is the all country world. So again, very similar. If you add all of those differences together and the different things that each of these managers are doing in their sectors, we will fill up all of the holes and cover all of the area that the opportunity set has. But again, you do see some differences in here. So what's a big sector that everybody always thinks about, and it's on everybody's mind right now? It is information technology, because that's the area of the market that did really well through COVID, because of, if you think of Zoom, like we're on right now, and Microsoft Teams and a lot of the things that allow the world to operate remotely, well, they all fall into that technology sector. That stuff did great through COVID. Now that we're coming out of COVID and those things got really expensive, everyone's right sizing their portfolios and saying, well, let's start getting rid of our technology and move in there. But again, you see the differences here. So Martin has more in the technology sector. Foresight has the second most, and then Arga and Redwood will be a little bit lighter. Now, three of those managers, so it's Arga, Foresight, and Redwood, though they're all below where the actual market opportunity set. So the MSCI All Country World ex-US, the index is at about 21%. All of them are lighter than that, but we have one that's still above, and that's Martin. So they still like the sector, and so they're heavier than the overall index. But in aggregate, you add them all together, you're probably going to be a bit lower than where the index is. And so and then the other one is that's probably important in this environment. It's the discretionary and the staple stocks, because those are the two you look at right now. Again, discretionary, those are the things that us as consumers, we don't need. They're the luxury things. They're again, when you go to the store, not the thing maybe you don't need, but if you have the money, you're going to buy it, like a Coca-Cola or something that falls in that category. The staple is going to be the things that you do need, your household products, your soap and your deodorant and stuff like that. You have to have it. You're going to buy it. Those staple things, those are what do better in this type of environment when everyone says we're going to tighten the belt, not buy things that we don't really need, but we still have to buy these things that we really do need, the staples. So again, that's kind of an important sector to look at and think about in this environment. And again, we have the differences here. You have Arga, who I talked about as the more volatile manager, and they're going to be a little bit on the heavier end of the spectrum for some of those areas. But they don't have any of those items. You can see where the index is all the way to the right, just shy of 8% for the staples. And then you have Martin, that's fairly in line with that at about 5%. And then you have two that are overweight. So again, the recognition of at least from Exponent's standpoint, that let's have some managers in there that offset it and offset someone that won't have that exposure and can take advantage in this current economic environment. So again, just a point that Exponence has done a really good job of putting together a portfolio of very complementary managers that's really covering all of these sectors and taking a good advantage of this full opportunity set that we have in that bar all the way to the right, the all country world. Let's move forward one page. And so again, this is interesting because these are the top 5 holdings, and this is again a risk characteristic that everybody always likes to look at. What are the top holdings, how concentrated they are? And I guess the first thing to look at is just to say, and again, liken this to what Brandon talked about when he said, Apple and what their overall weight is in an index. And so Apple and some of these other big names are, 8 or 10% in an index. And that's a pretty large position concentration. When you think about what is normal and what's fairly well risk controlled, about a 5% level. And so you look at this grouping of the top holdings and you really don't see anything well above 5. So Redwood has one. It's AstraZeneca. That's a healthcare name that I think everybody has heard of before, and that's getting close to 6, but not that big. So again, if you look at it on a single position basis, no major concentrations from anything that's really big in any of these portfolios. But I think even more importantly, if you look at everybody's top positions, I don't see any overlap in any of these. So no one is holding the same positions in their top 5 that others have. Now, I think if we probably were to go down into the bottom or the smaller of the smallest positions in some of these portfolios, maybe there is some overlap. I don't have that data in front of us, but at least from the larger positions, we don't see any of that. But again, I think what's also important too is that even on a global portfolio that has some things outside of the US, I think everybody sees some things in there that they recognize. So you see an Airbus, so big airplane manufacturer that I know everyone's heard of, Johnson & Johnson. So certainly those household products that fall into that staples category that everyone's heard of. Alphabet, that's Google. So certainly a well-recognized name. Berkshire Hathaway, that's the Buffett conglomerate that everybody knows. MasterCard, Apple. So again, things in there that we all know, we've heard of, real companies with strong balance sheets, earnings, make everyday things that we all have heard of and dealt with. So again, for the most part, some very recognizable names and good portfolios, but at the end of the day, nice and complementary and very well diversified. So with that, I'll pause, and I think the rest of the slides really get into, I don't know, Sue, if you want to fast forward a bit. Yeah, so the rest of these are just, I'm not going to spend really any time on these because these are more of the, I think, internal slides that Exponence uses. And I think in the future, when we invite Exponence to come talk, that they can spend more time on these types of slides that just say, this is how we actually do our internal due diligence. But I would tell you is that this process and some of the things that you see here, summary of a manager and organizational updates and things like that are going to be similar to what Gwelda and I do for the other managers in this portfolio, and even do that for Exponence on this portfolio at a more 30,000 foot view level to say, do they meet these check boxes for us? Has there been any significant team changes? Has there been any significant portfolio changes? Have they changed their process? Any other thing that causes us alarm? And again, even on a lot of these metrics, very similar to how Gwelda and I think about things when we say, okay, if we have an Intech in the portfolio, is that complementary to a TCW? And then are those managers complementary to what we have on the other side of the portfolio in an Edgar Lomax? And do all those things complement, create diversification, and create risk control for our portfolio? But also, do they give us the ability to make sure we're going to hit our return objective and meet all of our actuarial assumptions and cash flow assumptions and everything else on a go-forward basis. So again, Exponence does that on a more focused level with one portion of the portfolio in global equities, and then we do that on a more 30,000 foot view with the entire systems portfolio. Questions, comments?
No, again, I really like the detail here to dive into and better understand the portfolio. So I appreciate it.
Sue, do you want me to go over the email that you received from Private Equity Stakeholders Project real quickly?
Yeah, please.
Okay, so Sue received this email from a group out of Chicago called the Private Equity Stakeholders Project. And we wanted to make you all aware because it may be something you may hear about. And it said House Committee finds Landmark Partners back landlord Pretium use abusive tactics in pandemic evictions. So Landmark is one of your managers in the real estate group. Landmark was actually acquired by Ares in 2021, and they do have a small or minority stake in this group called Pretium. So we reached out to them because basically they're alleging that basically to make a long story short, that Pretium was buying up residential mortgages and then renting out the houses at very high rates. And when people could not pay or when they raised the rates, they were getting evicted. So there was a scream from this group in Chicago, and Jeff, keep me honest if I'm missing anything. But basically, we went to Landmark and said, look, this is headline risk. This is not a good look. This doesn't look good. For period, and especially for pension plans. They came back to us and they did respond back. And they actually have done a lot to mitigate this quote unquote evictions. They've given rental assistance. They have given people more time to pay their back rents. And they've also, there was a federal program put together, and they actually helped the people submit the paperwork to get a rental assistance. So Landmark has done everything that they can, but we talked with our real estate group about it, and it's something that some of the core managers are getting into, is because I know you all have heard about the housing shortages that are going on in the US. And as a result, rental rates are going up. This is not something that's just one particular manager. It's happening across the landscape. And it's a way for them to gain money, but some people are handling better than others. And based on what we're hearing from Landmark, with this smaller stake in this company they have, Landmark has actually been proactive in helping people not get evicted or helping them meet the rising costs through different programs. So we wanted to make you all aware of it. What I can do is send over to you what the response was from Landmark. Sue can distribute it to the individual committee members. So if anybody comes to you regarding this, you do have the facts rather than just hearsay. Just wanted to bring that to your attention in case you hear something about this.
So Gwilda, did this have any racial and social economic targeting to it?
As far as we know, no.
Okay. Yeah, because I think the big move now for a lot of private equity real estate people is to buy subdivisions. And I'm seeing the backlash, especially in St. Louis, with that, what that has caused. And so it'll be interesting to see if this is just one of those, more headline news in the future. But I would love to see that memo and make sure that we all kind of just keep it in our toolbox in case we needed to share with a trustee, not a trustee, but a constituent.
Sure.
So thank you.
We will send that over to you. Okay. I believe that's all we had.
Yeah, thank you, Gwilda and Jeff, for looking into that issue.
Thank you. We've taken up quite a bit of time today.
Yeah.
So I appreciate it. I think that the TCW presentation went a little bit longer than we anticipated, but it was a lot of good data. So we will adjourn for today. If there are no other questions, I just need a motion. And Jeff and Welda, thank you so much. And Welda, I just want you to know you were missed today at the Kennedy Symposium. I was there this morning, and believe me, your presence, your gender, your background was definitely needed because I was the only female of color in the
Oh,
in the
wow.
audience.
Wow.
So we missed you. We definitely missed you.
Yeah, I
Okay, I
had,
gotta run. I gotta run, Sue. I gotta take this call. Bye.
okay,
Okay.
thank you all.
Okay,
So I think we need a motion.
you know, motion. I'd like to make a
I make a
motion that
motion
we,
to adjourn.
I'm sorry. Go ahead, Al.
Richardson,
Go ahead.
second. Second.
I make a motion to adjourn the investment committee meeting today.
And Richardson, second.
All in favor?
Aye.
Okay.
Good night, everybody.
All right.
Good night, everybody.
Thanks,
Good
everyone.
night.
Have a good
Okay.
weekend.
Have
Bye-bye.
a good weekend. Bye now.
Bye.